Well, hi, everybody. This is Tim Harrington. I want to welcome you to the new Supervisory Committee Academy. This is the first of a series of webinars designed exclusively for supervisory committees and internal auditors. The Supervisory Committee Academy was created by 4 experts in the credit union movement. First, David Reed, who is an attorney and a partner in the firm of Reed and Jolly, and David will handle legal and regulatory compliance issues. Next is Brett Christensen, who is owner of CU Lending Advice, LLC. Brett has consulted with credit unions on lending issues for over 30 years, and of course, he'll be handling lending issues. Next is Sue Landauer. She is a partner in the firm Forensic Accounting Services, LLC, and Sue will speak on fraud detection and prevention. And finally, there is me. I'm Tim Harrington, a CPA and president of Team Resources. I've worked with supervisory committees and boards of directors for over 27 years. I'll speak on accounting and auditing issues as well as ways to improve your committee's effectiveness. The Supervisory Committee Academy will host a new webinar every month. The webinars will be archived in a library after the session. This will allow you and your supervisory committee to get the important training you need to keep up with the rapidly changing business and regulatory world in which we live. Another interesting element of the Academy is that all the sessions will be 90-minute sessions, but they'll be broken up into 30 or 45-minute segments, standalone segments. That way you can listen to the whole webinar at one time or listen to it in shorter segments to fit your schedule. We hope you'll become a regular listener at the Supervisory Committee Academy webinars. Now let's get started on today's topic. So welcome again. Welcome to the first and free webinar from the new Supervisory Committee Academy. This is an introduction to our webinar series, and today we're offering Supervisory Committee duties and responsibilities. I'm Tim Harrington, as I mentioned before. I'm a CPA and president of Team Resources, and I'll be your speaker today. I'll be walking you through the essential duties that every supervisory committee member should know. This is only a 45-minute course. It's a short course. It'll be one 45-minute segment. This one will not be broken up. The regular supervisory committee webinars will, as I said before, be 90-minute webinars in length and divided into 2 45-minute segments or to 3 30-minute segments for your listening convenience. Let's move to slide number 2. Just a reminder, the new Supervisory Committee Academy will provide monthly webinars on basic and advanced topics helpful to supervisory committees. Our speakers are all experts in their respective fields, and I just went through with you who those speakers were. On slide number 3, you see a picture of me and a little bit about me. So I'm president of Team Resources. I'm a CPA, have been consulting with credit unions for over 27 years, worked on over 1,500 credit union projects, a regular speaker at national and state conventions, conferences all over the country, spoken at over 1,500 events. I'm the former chairman of a board of a successful $150 million credit union, and I'm currently faculty member of 3 credit union schools. So that's a bit about me. And let's now talk about you and your role on the supervisory committee. One of the important things to remember is your role as a supervisory committee member is an honor, but it is not honorary. It's a very, very important role. As a matter of fact, it's an essential role in the safe governance in your corporation. Now, you are part of a governance team. You're one team, but there are 3 parts within it. The board of directors, the CEO, and the supervisory committee create the bigger, broader governance team. By the way, governance usually refers to what the board's job is, but governance is also a more expanded term into how we oversee the successful operation of any organization. Now, there are 3 elements here: the board, the CEO, and the supervisory committee. Your 3 organs, but your 3 organs in one body. One body being the corporation. By the way, the word corporation simply comes from the Latin word body. So you are 3 important organs in the body of the organization. Each of those organs has its own role, and it's important to know your role and do it well, and to be aware of the other organs' roles. And guess what? One of your roles is to make sure they do their role, not so much well, but not dangerously. What is the board's role? The board's role is vision and accountability. They are there to ensure a vision, a strategy is developed for the organization, and hire a competent CEO to carry it out. And third part there then would be to hold that CEO accountable for carrying out the strategy and the vision. The second element in the governance team is the CEO. And the CEO's role is leadership and operations. Leadership in today's world means visionary leadership, entrepreneurial leadership, not just a manager carrying out the will of the board of directors. Those organizations with managers just carrying out the will of the board of directors will not be the organizations, will not be the credit unions there in the future. We need today more and more, more than ever before, entrepreneurial leaders within our organizations. And one of the things we need to watch as a supervisory committee, and it kind of falls into our role in a broader sense, is there a breakdown in the balance of power between the board of directors and the CEO? And at what point does it begin to endanger the organization? Once it begins to endanger the organization, then I think we may have a role in that. But we'll get to that in just a moment. The third element of the governance team is you, the supervisory committee. And you're in charge of the audit function and to make sure internal controls exist, are adequate, and are carried out. Each of these elements of the governance teams has an important role. It's very important to carry out your own role well and to not try to carry out the other teams, the other organs' role. That will break down the team. Let's go to slide number 5 and look at a bit more about this. We'll start in the middle with the board of directors because they are the senior member of this triumvirate, this 3-organ team. And like I said, that's the board of directors. Their role is vision and accountability. You know, the board of directors is the only group that directly represents the members, the owners, in most credit unions. Now, I say most credit unions because today I'm mostly going to be talking about federal law for federally chartered credit unions, and the reason are federal regulations for federally chartered credit unions. And the reason behind that is that there are 50 state laws and there are territory laws, and we can't cover every law in our sessions. We have to focus on the federal laws and advise you to look at your state statutes to see what's different. But under federal regulations, the board of directors is the only group elected by the members. Supervisory committees are appointed by the board of directors. In some states, the supervisory committee is actually elected by the members too, which makes them directly accountable and can create some accountability issues and create 2 teams sometimes competing with each other. So this concept of the board being the only group that represents the member owners is very helpful in this process. So they are accountable to the members. We as the board, the supervisory committee, are indirectly accountable to the members because the members are always boss, but we are appointed by the board of directors. The next element of this is that the board hires and supports a competent CEO. And that support issue is important. It's a trust but verify. You have to trust your CEO but verify. Just as you as a supervisory committee have to trust your board of directors and management team, but you always have to verify. Trust is essential in this whole process. You have to trust each other. But when we're talking about hundreds of millions of SEM, and you might know what SEM is, but I'll tell you if you don't, it's somebody else's money, hundreds of millions of dollars of somebody else's money, people who are relying on us to protect that money, we always have to verify. And we as a supervisory committee are part of that very important verification process. Next element down is the board's role is to hold the CEO accountable to expectations. And those expectations are the expectations built around strategy and planning. Strategy and planning should be the expectations. There are some other ordinary expectations as well. Next, we have the board of directors ensuring efficient use of our resources, not allowing the organization to be wasteful of members' dollars. Next down here, we have communicate to the member owners, typically at the annual meeting. And the last item here is an important item, and that is the item of no surprises. What does no surprises mean? It means that the board of directors shouldn't surprise the supervisory committee and certainly shouldn't surprise their employee, the CEO. Why? Because surprises break down trust. There are times when things are going to come up and surprise everybody, but there shouldn't be elements of surprise where something is being worked on by the board and suddenly presented in a surprise fashion to the CEO. Vice versa, it shouldn't happen. We'll get to that in just a second. Let's go to the CEO's role right now and looking at their role of leadership and operations. So their day-to-day leadership of operations, there's no doubt about that. But they're also the long-term visionary leaders. They need to be the long-term visionary leaders of our organization. That's something that's new in the last decade and very, very essential. So the CEO's role is to carry out day-to-day operations of the business, provide day-to-day leadership, and it says perhaps visionary leadership, but I think today essentially visionary leadership. Their next role is to communicate as clearly as possible with the board of directors. And lastly, no surprises. The CEO shouldn't surprise the board. And again, why? That breaks down trust. Now, we are the third element here, and a very, very important element here. We are in charge of audits, the annual audit process, and making sure internal controls are adequate and they're working. So our job in that role is to trust the other two, but verify. We always have to trust, but we always have to verify. I've been an auditor for a long, long time, worked as a partner in a firm auditing credit unions, and I've audited directly credit unions for over 16 years. And there is a thing in auditing called professional skepticism. Professional skepticism, which means I don't distrust you, but it means I am going to professionally require you to prove everything to me that you tell me. Show me the documentation to prove it. Not because I distrust you, but simply because trust is never enough. In this business, when we're talking about millions, tens of millions, hundreds of millions, billions of dollars, trust is never enough. Next item down here is ensure financial statements are reasonable. We'll talk about that in some detail in just a moment. Next, determine if internal controls are adequate. We'll talk about that in some detail in just a few moments. And next, hire and cultivate a relationship with a competent outside audit firm. As a matter of fact, if you as the supervisory committee focus on that alone and nothing else, hiring a good firm, working with that good firm, getting the most out of the relationship with that outside audit firm, that is probably 80 to 90% of your role anyway. That is key to a successful supervisory committee. Let's move to slide number 6. We'll talk about the federal regulation 715. NCUA has a book called Rules and Regulations, and all of you should get a copy of that, have access to it, read it on occasion. It is not exciting reading, but it's very, very important reading. And Regulation 715 is the regulation that's specifically about the responsibilities of the supervisory committee. Now I'm looking at a place called A, the basic responsibilities of the supervisory committee. And what it says here is the supervisory committee is responsible for ensuring that the board of directors and management of the credit union do these two things. 1, meet required reporting objectives, and 2, establish practices and procedures sufficient to safeguard members' assets. So the first one is about financial reporting, both in the annual audit and in the financial statements that go with that, and in the call report. The next is about internal controls. Now next, let's go ahead and get into our specific responsibilities. This is item B, and it says here, to carry out the responsibilities set forth in paragraph A of this section, that was the previous slide, by the way, the supervisory committee must determine whether internal controls are established and effectively maintained, the credit union's accounting records and financial reports are promptly prepared and accurately reflect operations and results, the relevant plans, policies, and control procedures established by the board of directors are properly administered, and the policies and control procedures are sufficient to safeguard against error, conflict of interest, self-dealing, and fraud. So really these 4 elements, the specific responsibilities, still break down into the 2 basic responsibilities of financial reports and internal controls. The first one talks about internal controls, and we're to determine if they are established and effectively maintained. Well, we aren't experts in these fields. Most of us do not come from an accounting or auditing background. We come from a whole variety of backgrounds, which is very, very good and useful, but it doesn't give us this specialty that we could know. But the point is we don't need to know it. Why? That's why we hire an outside firm. That's why you hire an outside CPA firm, an outside audit firm to do this work for you, because they are experts in these areas. So they will look at the internal controls. They will tell you if they are adequate, they are being carried out on a regular basis, and if not, how to fix those problems. The next item down, we can do part of bullet number 2, the part that says, are the accounting records and financial reports promptly prepared? We can do that. We can tell you if they're taking a month, even 2.5 weeks to get financial statements together, that there's something wrong with the accounting system, the reporting system. In this day and age, most end-of-month financial statements can be put together within the first 10 days of the month. In many cases, much, much sooner than that because of the availability of good information today. If it's not happening that quickly, if financial reports are taking a long time to get together to present to management or the board of directors, then there's probably a problem somewhere in that reporting system, that accounting department, and it may be something the supervisory committee would want to look at or have a third party look at. Now, the next item in bullet number 2, accurately reflect operations and results. We can't do that. Why? Because we aren't experts. We are not professionals in this field. There are others out there who are, no doubt about that, and that's why we hire those professional outside firms. One more thing about that term accurately. When you hire your professional outside firm, whether it's a CPA firm or another outside audit firm, they will not tell you your financial statements are accurate. CPAs do not use this terminology. And there's a good reason behind it. They're going to tell you your financial statements are not materially misstated, or that they are reasonable or reliable financial statements. And why will they not tell you that they are accurate? Because accuracy comes down to the penny. And to determine if your financial statements are actually down to the penny accurate, your outside audit firm would have to do a tremendous amount of work and look at every single transaction to make sure it was right to the penny. And if it's not, then you would not be accurate. So they come up with a term called reasonable or material. These are financial statements that aren't going to deceive you. They may not be accurate because we don't know what accuracy is, but they're pretty darn close. Therefore, you can rely upon these and not be deceived. The third item down is a broad one that can kind of get us into trouble sometimes. So it's important to narrow this as much as possible. And what it says here is the relevant plans, policies, and control procedures are established by the board of directors, are properly administered. So we look at the plans, we look at relevant policy, we look at relevant control procedures, or our third party does that for us, and they tell us, are they being properly carried out? Now we get into the planning area. We look at the plan, and we're going to talk about this in just a little bit, but we might be involved in the planning process. Supervisory committee members are often invited, there we go, tough word there, often invited to the annual planning process. We have to be careful what we get involved with there because our job is to audit that process as well, and you can't audit your own work. We'll talk about that here in just a couple of moments. And the last item here is policies. So we are to determine whether policies and control procedures are sufficient to safeguard against what? Error, conflict of interest, self-dealing, and fraud. They're in the order of likelihood, I think, as much as anything else in that area. So we look at these policies and control procedures to say, would they be enough for us to avoid error or quickly identify it after it occurs, to avoid conflict of interest by our policies, or quickly identify it if it occurs, to avoid self-dealing and prohibit self-dealing and fraud, stop it from being able to happen, or identify quickly after it has occurred. Internal controls, if set up properly, should do all of these things for you on a regular basis. And that's why it's important to test these, again, on a regular basis. Let's move to slide number 8. And we're talking more now about the Supervisory Committee's responsibilities. And we get into item C, which is called the mandates, the things you have to do. So what it says here is mandates. In carrying out the responsibilities set forth in paragraphs A and B of this section, the Supervisory Committee must first ensure that the credit unit adheres to the measurement and filing requirements for the reports filed with NCUA, perform or obtain a supervisory committee audit, that's your annual audit process, verify or cause the verification of members' passbooks and accounts, that's the biannual verification required by law, and number 4, act to avoid imposition of sanctions for failure to comply with these requirements. So getting up to the top here, the first one is to ensure that the credit unit adheres to the measurement and filing requirements, that we file our call report on a regular basis, that we do test it to make sure it is reasonably accurate, and it's filed timely. The second one down is that we get that supervisory committee audit. We won't talk about the audit process here. That'll come in a later webinar, but you have to have an audit every year. But there's 4 choices of the type of audit you will have. A supervisory committee examination or a certified audit are the most common, but you can also have an audit of the balance sheet only or an audit of the internal controls only, but that's a topic for a later webinar. Next, we make sure that the verification of members' accounts has been accomplished. We'll talk about that, how we go about that, and why we probably will use a third party to assist us with that. And lastly, that we avoid sanctions by doing these things so that we don't get fined as a credit union. These are all important mandates, but of all these, by far the most important, I believe, is the one that we get that outside audit done by a good professional firm, and they take away a lot of the headaches from us.